Well, thanks for joining us here today. Whether you're joining us here live or online, we hope you find this presentation both valuable, maybe a little inspirational, but hopefully it's applicable to your business, to those you work with, to those you are interacting with, and maybe there's a nugget or something that you can take away and apply today or in the future that will transform your business, and you will know how to identify and understand your value and how important it is and what gold mines might be hiding because you might not be looking at it as you are today and as what you can do going forward. So let's get started. We are going to be covering a few topics, and just think about it as a nice workout that we're going to take in business. So let's dive in. Just a little bit about me, my backstory. I grew up in the country and never thought I'd be sitting here teaching or sharing about value and how to grow value. But it's incredible how life takes you on a journey. You're either going to sink or swim. And in the swimming, learned quite a bit and a lot of different things. Have a family. My family had a business and learned a lot of lessons. Unfortunately, didn't quite go all as planned, or there was no plan. Therefore, it went the way it did, and was able to learn what things could be put in place from a personal experience. And also, my better half also had a crazy accident when he was young and ended up having to start over from scratch. And what could have been done, it's the passion of what we do today. And that is part of my passion, is having a purpose, making an impact. And our company's name is RTB, or Raise the Bar. And bar we've broken down to belief plus actions equals results. So the belief you have will guide the actions that you take and the results that you end up having. And that's why we're here today, a purpose-driven company. We work with small business owners, helping them reduce risk, taxes, liabilities, enhancing value, efficiency, and cash flow, and anything in between that might be a relevant matter that a company's looking to achieve in their journey. So let's start. Why is value so important? And if you think about your business or the companies that you work with, there's so much focus on value and what are you worth and all these things. But why is it important? What are some questions we could be asking ourselves? And we're going to start today, right now. So do you know what your business is worth? This question comes up, and who seems to talk about it most are startups and those exiting. But everybody in the middle doesn't seem to talk about this question. However, it might be on your mind. What is my business worth? How would I know what I'm worth? What if I, haven't done a valuation or haven't looked at this in years? How do I know, based on my revenue, based on my expenses, how much somebody would be willing to pay? And what if somebody came today and wanted to buy your business? What is it worth? What is the IP worth? What are the different components of your business worth? And is that valuable? And how valuable are you? Well, can your business run without you? This is valuable. But if you're not able to do that, what other things in your business are valuable that would be seen as valuable? What hidden gold mines could be missed just due to lack of planning or lack of oversight on it? And do you have a system in place? You're probably watching this and maybe you don't have a system, and that's okay. But there are systems out there. We can help you do that. There are solutions to all of these things and ways to access all the information. It's just a matter of desire and wanting to actually have it so you can take your business to the next level. So in this process, I want to show you a few statistics, because obviously listening to webinars or people, meetings like this, it's one thing to hear somebody's opinion or their perspective, but it's another to look at the facts. So I always like to share a little of both. And the facts are 80% of business owners' wealth is locked in their business. And 50% of these businesses will transition unexpectedly. 100% will transition, no matter if you like it or not. So if you're on the front end of this and you're able to plan your exit, whether you choose it or not, how valuable is that to you, to your family, to your employees, to your customers, if you have a plan in place? That's very valuable. Now, 75% of owners regret actually exiting. And how could you plan for that ahead of time too? There is a plan. And if we looked at some other statistics, 60% don't understand their exit options. Now, 50% of people are going to exit their business involuntarily, and they don't know what options they had. Then they have no idea what they're worth or what could have been. So if you start now, wherever you are, and work into this, think about what's possible. 30% have no transition plan, 79% have no written transition plan, meaning it's all up here. But how many people can actually fulfill on that if it's all up here and something happens to you? Think about that one. 49% have done no planning whatsoever. 80% have not formalized a team. And don't we all know that leaning on somebody else and taking the knowledge and expertise they have can enhance our process too, because we're not probably going to make the same mistakes if we're working with somebody that made the mistakes before or with somebody else. And now you've got this great team that's going to work with you for your goal and end of game. And 94% have no plan for that next chapter. And that next chapter is what you're going to do after you exit this business or after you transition out. So all these things are great to know. Now, I want to talk about the 5 stages of value maturity. Having a framework for your value and what you're doing is great because it kind of gives you a guiding post of where you are. Today, we're talking about that first step. So if you look here, that first identify step is where we are. Now, these steps can be taken all throughout the year, right? You could have things that you're identifying, protecting, building. You might even be harvesting at some point and managing. We're talking about the first step, but over the course of the Roundtable series, we will cover all these steps. So we won't go into too much detail today, but it's good to have your knowledge set on what is the process, how there's actually a value maturity. I can mature my value in my business by putting certain things in place. So the 3 questions of basic value identification. I love this because sometimes we think we've got to have all these special softwares, and sometimes it comes down to very basic things that we need to be asking ourselves. And we can ask ourselves this in a weekly meeting, a monthly meeting, an annual meeting. But the 3 questions are, how risky is my business? Well, how profitable is my business? And if I'm able to reduce my risk and increase my profitability, then how valuable am I? Am I more valuable to somebody that would want to purchase me if I'm less risky, more profitable? Absolutely. But what's that third one? Yeah, transferability. So how transferable is my business? Could somebody take my seat today, run my business just the way I'm doing it, and have the same return on investment and the same income that I'm doing because we set this up to succeed no matter what? Value, right? You can do things in all 3 of these areas to help increase the value of your business. So the first one, right? That first quadrant, how risky is your business? Well, there are kind of 3 different buckets you can put these things in, and to be able to understand that we have things that happen that are just outside of our control. We have some things that are somewhat in our control and we could do something about, and some things that are totally under our control and we can do things about it today. And in any of these things, it's how do I plan to protect myself? How do I put the things in place? Can I, take whatever's happening to me and maybe put that on somebody else? Because if I'm not reinsuring some of this stuff, I am self-insuring. And do I or my business want to pay for any things like this? Fire, weather, the economy, a pandemic, death, disability. So looking at this, things that are outside of your control, you still have things you can do, actions you can take to help de-risk your business. So when it comes to things that are somewhat in your control, maybe it's underperformance that quarter or that year, product issues, you had to have a recall and things had to change over, but it's not the end of your business. It's just, what could I do to make my company less risky? What about bad press, bad employees, divorce, disagreements, and there's others. But this just kind of gets you in the framework of thinking, if I have things that are out of my control and somewhat under my control, what can I do? And even the things that are under my control, am I actually taking action on these things every month, every 90 days, every quarter? And how can I make it in simple bite-sized pieces that I can easily implement and make sure we're making an impact for our value in the business? So things that might be under my control is my owner centricity. Am I delegating? How much of the workload is on me and how much is on somebody else, and how well are they doing? Did we document the whole entire process? How much debt is in the business? How can I reduce the debt? That increases the value if I have less debt. Also, decision making, Maybe it's even yearly reviews on all the materials. You think about any agreements or contracts or buy-sell agreements. Has that been reviewed? Are you still at that level? Did you fund it? These things help with the risk of the business, and i.e. reducing risk increases value. So how profitable? The next quadrant, right, for that basic identification of value is how profitable is my business? Well, if you have two different numbers we're looking at here, you have your tax number and you have a real number. Just think of your tax number kind of that end of the year number that's like your net income. It's what you're going to be paying taxes on. And if you're working with us, we want to get this down as low as possible with everything we can by IRS code. And your real number is if you were to have somebody that want to purchase your business, what am I really worth? If I put back my salary, because that's what somebody else would make, and if I put back some of the other expenses that I'm taking as deductions that maybe not everybody else would be doing, then I start to get a more realistic number for my business and what somebody else, if they were to take my seat today, what they would get. So just think about in that terms, this can be a total game changer on how you look at your business, because a lot of people are looking at it as like, I want to make this money and I want to get my tax amount as low as possible. But if I'm looking at it from a value standpoint, what's my EBITDA? What's my earnings before interest, taxes, depreciation, amortization? What's your real number? So the next one on that 3 was transferable. How transferable is my business? Well, there's 4 capitals. Now, wait a second. Do you know the 4 capitals and what they might be? I think you'll probably get a couple and maybe all 4. So here you go. Customer, human, structural, and social. Each one very viable, and actually 80% of your business will fall into these 4. Now, there are 6 value drivers that we're going to talk about, which some of those overlay a little bit, but you may hear them in different contexts. So if you hear somebody talking about the 4 capitals, now you know. If you hear somebody talking about the 6 drivers of value, now you will know. Okay, so I want to share both because it's good to have a handle on whatever the conversation might be. So if we dive into the first one, customer capital, this can be so valuable for your business. If you think about how do I run my customer relations? How am I working with these clients? Are they on contract? Are they on long contracts? Are they on automatic renewal contracts? And if they're not, why not? It's kind of like that, we're gonna do this transaction and we're done versus a subscription model. If you had somebody that was looking at your company, which one would be more valuable, right? Of course, a subscription. So think about your business. How can you incorporate things that, one, are going to be valuable for your customer base, and 2, valuable for somebody else that might be looking for you? Now, human capital measures the strength of your people, the talent, the ability to execute. So a solid team. Companies are built on great people, and the right people in the right seat at the right time can really maximize your company. So think about where everybody's at. And even if you have a great team, are they in the right seats? And are they maximizing the seat that they are in? And how do you enhance that? Do you need to increase the pay to keep those people? Or what other retention tools can you put in place for your business that will not only increase your value, it will also increase your human capital? You have structural capital. This is all your strategy, processes, systems, everything in place about your business, the financial structure. This is like the gears that are moving that make everything work. So if this is solid, and you may need to go in and kind of review everything, what is missing in this area that could help you? Is everything documented? Are all your SOPs in order? Could somebody run your business, all of your business, if your whole entire team switched out, right? Obviously, if you're going to do a transition, keeping your team on board is great because they know the processes, they know the systems. But if it's all up here, how difficult it would be if you had to replace anybody on the team. So this is very valuable when things are documented and all in a structure and in a process that is repeatable. You think about the big box companies, right? McDonald's, Starbucks. You go to every single one and they all look the same and they all run the same. Think about your company. How can you instill some of those valuable strategies or tools in there to increase your value? And the last one, social capital. Think about your work life, the social work experience. What is it like at your location? What is it like to work with you? What's happening between the employees, the customers, customer service? What are the stakeholders saying? How can you enhance the customer loyalty? What about innovation? Are you guys doing things to really connect and increase this part of your value? Now, sometimes people forget this one, but it is sometimes one of the most important, because if you don't have happy customers and your team isn't happy, then how are you going to grow the business, and how things can totally transform when they feel taken care of on all levels. So if we go into a case study, I want to look at this. We have the 5 stages of value maturity. I want to look at those 4 capitals and how this could work for a company, and what you're looking to accomplish with increasing the value of the business, and how it can be done just by a few simple things. And obviously, the full case study that we're showing here is through the Exit Planning Institute, and you can actually download it at the link at the end of this. I'm going to give you a QR code. You can download the whole study. I'm only giving you the highlights. So the goal is to create an unbelievable impact on the business value by de-risking. So this is the goal of the owner, right? The strategy to use is utilize the 5 stages of value maturity and understand the risks, mitigate them, and build transferable value. So what happened? Well, they identified first, right? That was that first step. This is where we are in this conversation today, is identifying the value and understanding it. So what did the owner do? He went in and identified, well, their repair costs are in the millions. They're losing revenue to run down equipment. And the customer capital, 25% are invested, 75 long-term rental. This is good, right? Not too bad. How can we make it better? Social capital, improve the cultural and the morale from an hourly employee to a skilled professional. What a nice transition, right? If this owner is able to do this over time, how would the employees feel? Would they feel special and cared for? And the human capital. They need to attract and retain great people. So what are they going to do? So a few things went into place, and I'm going to show you a couple of them. In the protect stage, they invested in a new fleet of trucks. They increased the pay. That hourly employee to skilled employee or professionals was accomplished, and they kept clean financials, and they kept that customer value and actually increased their customer value, because now they had really happy customers. The ones that they had, all the trucks were new, everything was just running so great, so much so that they were able to double the income, and they were able to get an offer, and they were able to complete that transaction in 6 weeks. Wow, right? The goal at the beginning of this company, if you looked at it, millions of cost, millions of dollars in cost due to repairs. If you looked at it with the eyes of glass half full, this was a problem child walking in. But by applying these tools of increasing the value, this company was able to increase the value and actually exit. And you can look at the whole thing, but the quote from the owner says, "I now know to begin the business preparing to sell, and always be ready. No matter what, always ready." That includes your value. And as owner, you should clarify each day and ask, am I building an enterprise that's ready to sell? And is everything I'm doing building value in this business? Pretty powerful, right? So what are the value drivers? This is a great one. A lot of companies that are working diligently, growing great businesses, sometimes just don't know what the value drivers are. Now, I shared 4 capitals, which are a part of this value driver system, but knowing these and how they're used in business valuations can be really powerful. So what are the 6? Well, the first one, that is your strategic value. And then you've got your organizational value, your employee value, your customer value, your financial value, and your ESG value. Now, what's important to note here is if you look at the multiples, most 1 to 2 multiples are going to come from the financials. And financials are definitely key to a business. How profitable is a business for valuation? But these sometimes are not addressed at such a high level because most people don't know that these hold value. Each one holds value. And if you're able to increase the value in each one, you actually can increase the value by a number mark, meaning it's actually worth at a figure. It's not just a term, and if I do these things, I'm going to be more valuable. No, you can actually quantify it by doing a valuation. So you see here, this is the range of value. And what I want to focus on is this bell curve. Each company, based on the industry that they're in, will fall into a range of value. Either weak, which is on this left-hand side, a high risk. It will be average, just like everybody else in their industry, just most of the companies fall into this range, or low risk and high value or best in class. Now, our goal is to get you wherever you are on the highest we can on the best in class bell curve, get you all the way over here to this, the farthest we can get you. So it's more valuable and you make more money on a transition and it's more transferable. Now, if you look at this, you'll see those same 6 value drivers are here. And these have numbers associated with them, percentages. And that's because when you go through the valuation process, you're looking at all of it. You're looking at the financials, there's questionnaires to fill out, and breaking it down based on the industry and everybody else in your industry that's answering these questions. This is how risky your business is. So a Q score based on the platform that we use, which is an algorithmic breakdown and mathematical computations, it comes in and shows you how risky you are compared to the rest of your industry based on the NAICS code. So this company, if you were to look at here in this example, would be in the average range, right? 685, 675, somewhere in this average range they would be. So because we're talking about value, it'd be good for you to know what are the valuation types. Because if you do want to do a valuation at some point in the future, which is highly encouraged and suggested, there are a number of reasons why you want to have a valuation done. It could be for not only for your business and knowing just what your value is, it could be for a sale or an acquisition or negotiations for an acquisition. It could be IRS compliance. You need to do it for a different reason based on that. It could be for gifting, estate planning, maybe it's a divorce. There's a lot of reasons to go through and have a valuation done. There are ones that are just enterprise value where you're just finding out, and some that are certified, especially for things like ESOPs and IRS compliance. They need to be certified, and they use usually three different forms of valuation and then compare across. I'm going to share just a couple of them just so you have some knowledge. And definitely reach out to us if you're looking to do evaluation and want some more information. So the first one is the market approach. Now, our spotlight valuation, which we offer complimentary, that's a market approach. It's a market multiple valuation. You're looking at the other companies in the same industry and then seeing how do you, level up to them. Where are you based on answering the questions and how risky are you? How much is your revenue and what's your profitability? The next one is a discounted cash flow method, which takes your cash flows and your projections and brings it back to present day. And what are you worth today in present day dollars? Now, the next one is the asset-based approach, which is great for manufacturing, real estate, those that have assets. You'll need an asset-based approach valuation. And then the last one is the SDE, which is what is the seller discretionary earnings, which is what most small businesses use because most of it is on the individual or on a very small team. So you're looking at what are the profits, what are the expenses, what is the salary, and putting things back into just like the real number, putting everything back in. So if somebody were to take your business over, what would they be able to earn? So this is all part of the SDE approach. Of course, we can go into this more detail later and through our sessions, but at least it gets you thinking now. So I talked about the spotlight valuation just for a minute, and this is an example of one. It's a small business. The earning, you can hear revenue, $331,000, EBITDA, earnings before interest, tax deduction, or depreciation and amortization. That's 180. Now, there's something interesting to note about this, and if you're looking and you're analytical and got some eyes for this, you'll see that here's our bell curve. This is on the far left of the bell curve is the weak side, and the far right is the super strong or best in class, and then you've got average. Now, the line here is way up here at 54%. That's pretty high. Most companies are not a 54% profit level or EBITDA level. And therefore, this one is highly valuable if you're looking at it only in terms of numbers. But on average for this industry, you'll see about 14 to 25%, which is more on average of what most companies are. But wanted to throw you guys a curveball and see if you picked up on it. You'll see here, these are state of the business and state of the owner. This is also done through the Spotlight evaluation to see how you are marking on those different things from processes and systems to record keeping. And these are areas you can enhance your value by just putting things in place and getting them taken care of. Our more extensive valuation example here is a discounted cash flow. Not going to go into this today, but you can see that same scoring system here. This one pulls out just the ESG, so you can see that each quadrant has different aspects that it's going in, giving you a range, giving you the breakdown of what is the results of that in that section and what you can gain from it. How are you scoring? Even to the value gap, where do you range on the current value versus the potential value? What is the money markers of value based on those 6 value drivers? All highly valuable for a company that's looking to grow the value, understand where they are, and then where can they go? And what are they really worth based on the industry, right? My current value versus potential value. And I do want to give you an example because sometimes I think that this gets to be really complicated, but I want to try to explain this in as simple as possible way. Now, this is an example. This is assuming a company makes $14,944,000. The profit margin, if it were 8%, would be at 1.1 and some change. If it was 11% profit, you see it starts to go up, right? And 15% profit, right? You're getting more back into your pocket. But if you looked at how you can increase value, if you remember, I told you 1 to 2 times value is the financials. So you can only earn so much and have so much expense. But if you were able to increase the value in the other 5 value drivers, then what's possible? What's possible for your company? How you could actually grow the value of your business without having to increase the revenue. And the profit does help, but how can everything else help? So if you look at the multiples, if I were to take this in times, this figure here, with a multiple of 4.09, let's say this is just a, weak side, right? The below average side, and I times it by 4. Look how we pop up to 4.8. But if I was average and I multiplied, my multiple was 6, look what happens to the figure and the value. And if I was able to take it up to 7.8, let's say in this example, that's the best in class, look at the value difference. Now, this is all assuming the same amount of sales. Pretty cool if you're looking at that. So if you think about how valuable your profit is and how valuable these value drivers are and how your value can literally increase just by putting these things into place, now it's, what do I need to do? How do I make my business more attractive? Well, if you look at this, what makes, and you got to know this, what makes a business attractive? Now, I'll just wait for a second so you can think about it. And there's an easy acronym, 3 letters, starts with an R. Exactly. ROI. Buyers look for return on their investment and return on their money. And if you have an attractive company, you are going to, a buyer will be more willing to pay more because the higher the perceived return on the investment, the more attractive the business is. Now, if you were exiting, there are 2 things that you need to prepare. The business needs to be prepared and the owner needs to be prepared. So keep that in mind as well. So what are the benefits? If you were to take on this value growth opportunity, what are the benefits? What would you actually be able to see in your business? What are some things that you walk away with? Well, if you were to focus on value, you could be better prepared for an exit at any time. And how many people are going to transition out of their business? 100%. And how many are going to expect it? 50. It helps you prioritize your actions. It gets you thinking like an owner. You can use this as a benchmark to grow your performance year after year. This is a yearly, if you did this year after year, just think about how powerful that would be for your company. And not just from a selling it aspect, like actually your company being more valuable and working smoother, operations smoothing out, things are just working. You just think like everything clicks. It's like a system. How nice that would be, right? And overall, I want you to kind of get on the thought processes. These tools and these steps are actually easy. It just takes time and dedication and a desire to get through what you need to do. And when you're working with a team that helps you get through it, guided implementation, how nice is that? So you don't have to worry, did I get everything done? Did I do it right? You got a team that's saying, hey, we've got these things still missing, and this is what you got done, and look at what we did. That gets exciting. It also helps guide decision making. You will make decisions in alignment with the exit option you have chosen, the value growth you have chosen, and those decisions may be different if you were not focusing on that value and we're not focusing on that. So just think about how powerful that can be for decision making. It enhances your transferability for sure. It mitigates your risk because that's one of the three. It aligns your goals and your priorities because now you are focused on what you're doing. And if you are focused, you might be focused more in an area on value that might be enhancing your business more than what you had before. Okay. Reduces the value gap. So if I reduce the value gap and I increase my multiple, how powerful is that? There are three gaps. There's a wealth gap, there's a value gap, and there's a profit gap. If I reduce my my value gap, make my company more valuable, I'll probably increasing my profit gap and making that better. And then I'm also in that gap in profit, meaning I'm more profitable, and then I'm increasing my wealth and I'm reducing the gap in between. Is that more valuable? Is that valuable for you? And the benefit that comes with it. And overall, focusing on value and an exit is a good business strategy. So what's the process that we go through? Well, we've got a 5-stage process. We first need to just find out where you are. Just like the identify on the 5 stages of maturity for value, we go through a discovery process. Everybody's at their own stage in business, have done different things. We need to kind of really understand where are we. And part of that is this free valuation that we give you, this spotlight valuation that kind of puts a little stamp on where we are right now today based on what you've been doing. Then we design what's the best next step, decide what are those steps going to be, go through the implementation. Is this going to be, a 90-day sprint? Is this going to be 2 90-day sprints? Or what is it going to take to actually implement? And who are the people in the team that we need to implement it? And what is the most relevant thing that will help you in your value or you in your business at this time? And then obviously the manage, keeping up with these things to make sure that it is in line with your goals and what you're working on. So let's review what you guys got out of this today. So what percentage of owners will transition? I hope you got it 100%. But what percent are going to be not on our terms? Yeah, that's right. 50% will not be on our terms. So what are the 3 basic questions to ask? Hopefully you remember this, the 3 that we talked about at the beginning. How risky is my business? How profitable am I? And how transferable am I? And exit planning is what type of strategy? I know it's almost too simple. It's just a good one. It's a good one to have. And what are your 4 capitals? Hopefully you remember those 4. There are 6 drivers, 4 capitals: human, customer, social, and structural. And what are the 6? Let's see if you remember. Strategic value, organizational value, employee value. Let's see if I remember them. You got your ESG value, financial, and that last one is the customer. Okay, I didn't do it in order, but you got it. Hopefully you got it too. And what makes a business attractive? That ROI, return on investment. So I want you to think in your situation, right? What is the one action you can take today that reduces the risk in your business and make you more valuable? What could you do today? So just take a few minutes and jot down what you could do today to actually do this, and how powerful that would be for your business to look at that. And maybe you've got a longer list than you thought. That's okay. Now it's, what do I need to do to get those things done, and who do I need to work with? So the second question I want you to ask yourself is, what is the one action you can take today to make your business more transferable? What could you do today to make it more transferable? We talked about a number of things, but we didn't go into detail. But we will in future sessions, but just take some notes and some thoughts. And if someone were to sit in your seat today, what would they need to know to run your business as if you were not there? That's a good way to see what is needed to make your business transferable. And the last question is, what is one action you can take today to increase your value? And maybe the first step might be just to identify it, to understand where you are, and then what do I need to do to go forward? So I've given you a few steps. You can download our roundtable tools, and you can complete the spotlight valuation either with me, or you can complete it and we'll schedule a time and we'll review the results. You can explore ways to increase your value. I'm happy to sit down and chat with you about it and see where you are and where you want to go and what's going to take to get you there. And then, of course, attend an upcoming roundtable that we've got coming up, or attend another event. We host other events, so there might be something that might pique your interest that could be valuable for you. So with that, I want to say thank you for joining us today. Hope you got value out of this session to identify and understand the value of your business, how important it is to think about value today, and how it is such a great strategy going forward. And the value of your business and the return on investment for somebody else, and what do you have control of? And I'll leave you with that. And until next time, keep raising the bar.